Markets turning lower in midday trading after downbeat debt ceiling negotiations, or at least some commentary about that. Also some hawkish talk from Fed Chair Powell, if you want to call it that, but recovering some of the losses by the afternoon. Let's get to the action with our panel. Joining us now is Victoria Greene, G Squared Private Wealth CIO and a CNBC contributor. We also have Carl Riccadonna, BNP Paribas, Chief U.S. Economist for Markets 360. Good afternoon to you both. Victoria, I'll start with you. The fact that we did see, and with the S&P, we were down fractionally. We ended down around 41.93. Technicals have been in focus, particularly the last 24 hours or so. Your thoughts on these levels and what moves us in either direction in a more meaningful way?
Absolutely. Thanks, Morgan. There's been so much optimism lately. The debt ceiling's getting done. We're bursting above 4,200. I have to point out that the close today, right below 4,200, is exactly what happened in February. We had a brief step above it. Everybody got excited. We cannot hold the technical level. And again, it becomes this resistance that is held. We have these lines in the sand. It's going to be difficult for them to cross this in the negotiations. The Republicans want to roll back and they want actual cuts. The Democrats want to freeze, and they are very hard pressed to be able to get their constituents together for a vote. So I think you're going to see a rough week ahead. But I have to say, again, on a technical basis, this failure right at 4,200 is a lot like what happened in February, and I think it bodes poorly. Yes, we had an up week, finally a little bit of pressure off, but we're still stuck where we cannot break out of this trading range, and a failure here technically is a bear signal, at least in the short term.
Yeah. Carl, I mean, we had a lot of Fed speak today. You had some more hawkish tilt to some of the officials that spoke yesterday. You had Powell this morning, too, seen as opening the door or continuing to maybe hold the door cracked open to a pause in rate hikes as well. Meantime, pretty big move in the 2-year note in terms of the yield moving higher this week. How to make sense, I guess I should say, of some of the different commentary we're getting right now and what it means for the market?
Well, I think what we saw over the course of the last couple of days was really the hawks are trying to push to have some optionality around that June 14th FOMC meeting. So from Lori Logan at the Dallas Fed through a couple of other more hawkish members of the committee, they're really trying to make the case that maybe we need to keep going, maybe not at the June meeting, maybe at some later meeting this year, but they're pushing for a need to do more as they're not seeing the improvement they need to see in the economic data, in particular in the inflation data. Now, they've been kind of trying to push to maybe get it towards 50-50 odds of a rate hike at the June meeting, and the market has been very resistant to that, and I suspect a big part of that is the dark cloud of the debt ceiling looming just ahead of that meeting, possibly as early as June 1st. And so that, it's a tug of war, a push between the two. And then today, of course, as Jerome Powell was speaking, and his remarks were strikingly similar to what he said at the May press conference. So the only new information there was that there was no news on that front. But at the same time, we had Janet Yellen talking about bank consolidation and Republicans walking out of the negotiations, and that pushed that probability of rate hikes back down. I think people are falsely attributing that to the Powell comments, and it was really those other factors.
Okay, so Victoria, Carl mentions the debt ceiling risk, and I wonder if the debt ceiling risk isn't so much default as repricing. You know, like when you're having a really good dream, you don't want to wake up, but your spouse rolls over or the cat meows or something, and then you're out of it. Like, is there the risk that this brinksmanship around the debt ceiling actually just causes a repricing across the market? And so even if, things do get solved, if there's a bounce back, it's not as strong as where we are today.
Yeah, and I think the markets are absorbing the fact that we are going to maybe see a more acrimonious week next week than we thought. Wednesday and Thursday, everybody loved each other and the deal was going to get done. They had the right people in the room working on it. And then reality hit today that they're still a little farther apart. I tend to think it will get done, but it's going to be dragged out. And quite frankly, politically, it is in the Republicans' best interest to kind of make this hurt. They have a little bit of leverage. It would be horrible to default. I have to say that is a long-lasting scar if we default. It's not just today, but you're talking 30, 50 years down the road. You have all these increased costs. Can you imagine if we get downgraded again? So I think the political games are very dangerous here, but you have a lot of factors coming into this, and that's going to drive what happens with the Fed hikes. But I do think, I like to say, eventually the adults are going to show up to the party, and we will get it done. It just might be a little painful getting us there.
Carl, quickly, you've described as what we're experiencing as a gradual downturn. I'm guessing you still feel that way after earnings from Walmart, Target, and others. Is it gradual like soft landing, or you think too gradual like the Fed might actually have to hike again?
Well, it's first a little and then a lot. So I think what we're seeing now is a deceleration. The economy grew about 1% in the first quarter. I'm looking for a similar growth profile in the second quarter. But then as we go into the back half of the year, I think it actually turns into outright contraction and recession. We're not there just yet, but if we look at the pace of hiring, consumer trends, those headlines you mentioned from Target and Home Depot, things are slowing.